In 1978, Congress passed a tax bill. It was 1,379 pages long. It covered dozens of provisions, and buried on page 1,390 was a single paragraph called Section 401. Subsection K. Nobody campaigned on it. Nobody held a press conference about it. No senator stood at a podium and announced that America was about to fundamentally restructure how its citizens retire. It just sat there, quietly, like a grenade with a very long fuse and a very slow countdown. And then in 1980, a benefits consultant named Ted Bennett read that paragraph and realized something. You could use this obscure tax provision to let employees defer a portion of their salary into an investment account, tax-free. Ted Bennett called it a brilliant idea. He was right, it was brilliant. Just not for the reason he thought. Because what looked like a retirement savings tool was actually the beginning of the largest transfer of financial risk in American history. And most people still don't know it happened. Here is the context you need, because the story doesn't start in 1978. It starts in the 1950s, when the dominant retirement structure in America was the defined benefit pension. A pension is exactly what it sounds like. You work for a company for 30 years, and when you retire, the company pays you a fixed monthly income for the rest of your life. The math is simple. The risk is the company's problem. They manage the investment pool, they absorb the volatility, and they guarantee the outcome. At the peak of the pension era, in the mid-1980s, nearly 62% of private sector workers with retirement benefits had a defined benefit pension. That number today is under 4%. Think about that. In less than 40 years, the dominant retirement model for American workers went from something that guaranteed income for life to something that says, here is an account. Good luck. Try not to panic in 2008. And that shift didn't happen because pensions failed. It happened because pensions were expensive. And a 401k is much, much cheaper for the employer. That is the entire story. Everything else is decoration. Here is how it works. Under a pension, the employer carries all the risk. If the market crashes, the employer has to make up the shortfall. If people live longer than projected, the employer keeps paying. If the investment pool underperforms, the employer absorbs the loss. Under a 401, the employer matches a percentage of your contribution and then walks away from the table. If the market crashes in the year you were planning to retire, that is your problem. If your investments underperform for a decade, that is your problem. If you live to 91 and outlast your savings, that is also your problem. The employer took all the risk, packaged it into an investment account, handed it to the employee, and called it empowerment, which is the most expensive rebranding job in financial history. And the financial industry was ready and waiting, because now, instead of a few pension fund managers overseeing a large professionally managed pool of capital, you had 70 million individual Americans, each needing their own investment account, each needing funds to invest in, each needing a platform to manage it on, and each paying fees for every single piece of that chain. The mutual fund industry tripled in size between 1980 and 1990. The number of mutual funds went from around 564 in 1980 to over 3,000 by 1990, and over 10,000 by 2000. That growth did not happen because Americans suddenly fell in love with portfolio diversification. It happened because the defined contribution system created a captive audience of people who had no choice but to put their retirement savings somewhere, and the financial industry was there to greet them with open arms and a 1.2% expense ratio. And here is the number I want you to remember. A 1% annual fee on a retirement account over 40 years can consume between 25% and 30% of your final balance. Let that settle. Not 1% of your final balance, up to 30%, because fees compound the same way interest compounds, except in reverse, against you, quietly, invisibly, every single year, whether the market goes up or down. On a $500,000 retirement account, that is potentially $150,000 quietly extracted by the people managing your money over the course of your working life. And most people have no idea it is happening, because the fee isn't a bill. It is a line item in a prospectus that nobody reads and everyone signs. Which brings us to the part of the story that turns the stomach, because the 401k's problems aren't just structural. They're generational. The generation that built pensions and retired on them handed their children a defined contribution system, just in time for those children to experience the dot-com crash of 2000, the financial crisis of 2008, and a decade of near-zero interest rates on bonds, which removed the safe haven option from the equation entirely. The average 401 balance for Americans between the ages of 55 and 64, the people closest to retirement, is approximately $185,000. The common rule of thumb for retirement savings says you need roughly 25 times your annual expenses to retire safely. If you spend $50,000 a year in retirement, you need $1.25 million. Most Americans in their late 50s have $185,000. That is a 15 to -1 shortfall. And the response from the financial industry to this gap is always the same. You should have started earlier. You should have saved more. You should have contributed more in your 20s. You should have been more disciplined, which is a polite way of saying the product is fine. The user is the problem. But the product has a 93% completion rate only if you are financially literate, emotionally disciplined enough not to panic, sell in a crash, employed in a job that offers a match, not hit by a medical emergency, not supporting aging parents, not living in a housing market that took 40% of your take-home, and also happen to retire in a year when markets are near a peak and not a trough. Remove any one of those conditions, and the math starts to break. Remove 2, and you are working until 72. And the timing problem is brutal and underappreciated, because the stock market doesn't care about your retirement date. If you are 63 in 2008, you are watching 40% of your 401k evaporate in real time, in the years you were supposed to be coasting. If you are 63 in 2000, you are watching the tech bubble pop and your NASDAQ heavy account lose half its value just as you were 2 years from the finish line. There is a term for this in financial planning. It is called sequence of returns risk. It means the order in which your returns arrive matters enormously. 2 investors with identical average annual returns over 30 years can retire with vastly different outcomes, depending on whether the bad years came at the beginning or the end. A pension doesn't have this problem. The institution absorbs the sequence. You get your fixed check regardless of whether 2008 happened the year before you retired or 10 years earlier. The 401 transfers this risk to the individual, and then it asks the individual to manage it without training. Here is the historical parallel that keeps me up at night. Because defined, benefit pensions didn't just disappear in the private sector. The cities and states that still maintain large pension systems are quietly discovering that decades of underfunding have created a debt that cannot be paid with optimism. Illinois has an unfunded pension liability of over $200 billion. New Jersey's unfunded liability sits around $90 billion. And across the country, state and local pension shortfalls total somewhere between $1 trillion and $4 trillion, depending on what return assumptions you use. So we have the private sector, which abandoned pensions and handed workers a 401k that most can't retire on. And we have the public sector, which kept pensions but in many cases didn't fund them properly for decades. 2 different systems, 2 different failures, both landing on the same generation. The one sold empowerment and handed them market risk. The other promised security and may not be able to deliver it. Which means the retirement crisis in America isn't a future problem. It is a present one that hasn't finished arriving yet. Here is the uncomfortable truth. The 401k is not a failed retirement system. It is a successful wealth management product that was sold to the public as a retirement system. Those are not the same thing. A wealth management product rewards people who have money, who invest consistently, who make good decisions under pressure, who live without major financial shocks, and who retire at the right time. A retirement system is supposed to work for everyone else too. The pension wasn't perfect. Plenty of companies underfunded them. Plenty of pension funds made bad investments. But the design was correct. Put the risk on the institution that has the scale to absorb it. The 401k design puts the risk on the individual who has the least capacity to manage it, wraps it in tax advantages that feel like a gift, and charges fees for the next 4 decades. And the people who design this system, the mutual fund companies, the brokerage platforms, the plan administrators, have done extraordinarily well. The defined contribution market in America is now worth over $10 trillion. That is $10 trillion in assets generating fees for financial institutions, regardless of whether the people those assets belong to can actually retire. So here is where I am going to leave this, because I am not saying don't contribute to your 401. If your employer offers a match, take it. That is a 50 to 100% instant return before the market does anything. What I am saying is this: the next time someone tells you the retirement crisis is a personal responsibility problem, ask them when the pension disappeared and who benefited when it did. Ask them how much of your balance goes to fees over 40 years. Ask them what happens to sequence of returns risk when you can't control it. And ask them who lobbied Congress in 1978 to make sure Section 401 stayed exactly the way it was. Because the system isn't broken, it is working exactly the way the people who designed it intended. The question is, were those people designing it for you? Drop your take in the comments, because I want to know if you think this was inevitable, or if this was a choice someone made, and someone else was never supposed to figure that out.